Hello, everybody. Luke Gromen, FFTT. Hope you are all well. I apologize. We were unable to go live tonight due to technical difficulties. So we're doing the next best thing, trying to adapt and overcome. We're recording this, and we will just put this online as we normally would, put it in our Twitter feed as well. So big win today for the Browns, 2-1 winning record. So we're excited about that. Hope everybody had a great weekend. Let's jump right in here. First off, from FA, do you see rates going higher or lower? I see real rates going a lot lower. I think one of the biggest misperceptions in markets today are that real rates have bottomed. I think real rates could easily go to -5 to -10% or even lower. The last time U.S. debt to GDP was this high, they went to -14%, and the U.S. is in far worse situation fiscally, demographic, etc., entitlement picture than they were then. So I don't think nominal rates are going to move all that much, though. If nominal rates go much higher, you're going to end up with interest expense higher than tax receipts. Fed has to print the difference, or the U.S. defaults on treasuries. Or if you take rates much below 0%, you really can't do that without effectively ending the U.S. dollar's reserve status, because you'll have $6 to $7 trillion in FX reserves in dollars begin to bid for 0% yielding AAA rated reserve assets, which are also known as gold. So you can't go below 0. You can't go much higher without sending interest expense over tax receipts. So I don't think nominal rates will move that much. But I really think real rates have much further to fall. From EK, can you briefly mention yet again why the Fed Standing Repo is so significant? Is it a transmutation of risk? I wouldn't call it necessarily a transmutation of risk. I just think it's a continuation of QE without having to call it QE. And so I think it's important to follow the flows. So QE, let's run through how that works. QE, the Treasury spends money. They issue Treasury bonds. Some of those Treasury bonds are bought by banks. Banks then sell those Treasuries to the Fed in QE. That creates bank reserves. Under Standing Repo Facility, instead of the Fed buying Treasuries from banks via QE, the Fed can just repo Treasuries from the banks as needed. So reverse repo is the Fed sending the treasuries back to the banks. In standing repo, the banks can repo the treasuries to the Fed as needed. And so I think in crude terms, the way to think of it is the QE is effectively an addict injecting heroin via syringe into their left arm. And so QE is removing that syringe or reducing the amount of heroin injected in that syringe, a QE taper. However, standing repo is an IV in the other arm, and it's dripping the heroin in as needed. And so to me, the importance of standing repo facility is not that it's a transmutation of risk, although I guess if you wanted to look at it a certain way, I guess you could say it that, but it's simply continuing QE without having to call it QE. You're able to improve the Fed's credibility because they can say, ooh, look, we're tapering. We told you we were going to taper. We're tapering. While not actually tapering, while still providing the markets and the economy with the liquidity they need to keep those markets actually functioning, because they can't function without the heroin, so to speak. From DM, aside from defaulting, are there any scenarios you can foresee that would nullify the thesis that the U.S. has to keep markets propped up for years via inflation or revalue or devalue the dollar versus gold/Bitcoin? Yeah, there's, I think, two big ones aside of sort of devaluation or inflation, which is you could have a massive productivity increase in economics in the U.S. economy. And so by massive productivity increase, given the debt involved, you would need something like portable nuclear fusion rolled out over the next 2 years at a household level. So we're talking about a revolutionary change in productivity. So it's highly unlikely, could be happening. Maybe there's some sort of Manhattan Project happening as we speak, but it's a long shot. It's a Hail Mary. The other way you can do it is find a way to default on a quorum of baby boomers' entitlements, and have that same way of defaulting on those entitlements ensure that the boomers, a quorum of the boomers' wealth passes to their kids and grandkids who have a much higher marginal propensity to consume than the boomers do. And so if you basically can sort of renege on boomer entitlements and take their wealth from them and pass it on to their kids and grandkids in substantial size, that too would be a way out of the predicament. From CS, the ECB is going to spend trillions to avert climate change and want to top-down redesign a green global economy. Is this also an attempt to kick the sovereign debt bubble up to a new ESG/carbon credit bubble? I think I think you could say that. I think ultimately, if you create these green assets, then we've already heard central banks, particularly in the West, talk about a climate change mandate, particularly the Fed and the ECB. And so if they create green bonds to make these changes, I would not be surprised. I'll put it that way. I would not be surprised at all if we wake up in a year, 2 years, 3 years and find the need for central banks to do green QE. And who can argue green QE, because it'll just be good for the environment. But that what will be happening is effectively kicking the sovereign debt bubble upstairs to sort of a global climate change debt MMT project. And it could probably work. The other thing I think they're doing that people still aren't talking about as much as I think they should be is this. I think when we hear climate change, we should be hearing peak cheap oil, peak cheap gas. I think there's an acute supply-demand problem developing in fossil fuels if we look out 3 to 5 years, maybe less. And I think authorities understand that and are acting as aggressively they are with some of this climate change stuff as a result of that. From Bonnie, you like to compare the current upcoming negative interest rate period with the post-World War II decade plus. However, that was a time of rapid economic growth, abundant oil, manufacturing jobs, and low inequality. None of these apply today. Correct. That's a great point, Bonnie. So what are the implications of today's negative rates? It's a tremendous question, and I think you're right. I think, again, it ties back, if we don't get some sort of revolutionary productivity, growth-enhancing development in the economy globally, and in particular in the West, then I think we start to look much more, we have to look much more to the immediate post-World War I decade for an analog for much of the world, and in particular the West. You've got massive inflation adjusting war reparations. The Germans had massive inflation war reparations. The United States and other Western nations have massive inflation adjusting entitlements. You had massive wealth inequality then, you have massive wealth inequality now. You had you had deindustrialized economies, there by war, here by trade policy, this time around by trade policy. You have massive technological advancement creating, displacing of jobs. Then it was automation and radio and the assembly line, and now it's everything we've all talked about. So the punchline to all of this in terms of what does it mean, I think the U.S. situation in particular starts to be much more comparable to those of European nations post-World War I. So some blend of the U.K., France, Germany, and Russia. Of those four, two of them hyperinflated, the Germans and the Russians. There was severe political dislocations in pretty much all of those places. The other two, Germany and France, did not hyperinflate, but the French devalued their currency significantly, at least twice between 1920 and 1926, I believe, maybe 7. And the English held out, had massive unemployment and deflation until they finally agreed to massively devalue the pound relative to gold in September of 1931. So ultimately, I think the picture is probably much more akin to after World War I than after World War II is the answer, and not post World War I Europe, post World War I Excuse me, not post World War One U.S., post World War One Europe. And from CM, are we likely to hit an inflation point and flip back to an inflationary economic paradigm? If so, what happens to different assets? In my opinion, yes, that's already in process. Something a lot of the debt deflationists point to is, well, debt's always deflationary, and most of the time it is. But virtually all of the great inflations in history have had at least a component or were outright driven by sovereigns with the ability to print fiat currency, trying to keep insolvent sovereign debt solvent. And that's where we are. They can either let some of this debt go away and default on it, or they can print money and pretend that the rate should be 1% on sovereign debt in the West at a blended rate, whatever that rate is, as long as their balance sheet keeps growing. So you've got trying to keep sovereign debt solvent when it's not really solvent. If it was allowed to actually be a free market, that's inflationary over time. Entitlements. These are inflation adjusting. We're talking about the U.S. is talking about a 6% cost of living adjustment for Social Security next year right now. That's inflationary. Deglobalization. If globalization was disinflationary for 30 to 40 to 50 years, it stands to reason that deglobalization will be inflationary. And I think we're seeing the very early signs of it when we talk about the inflationary impacts of these supply chain disruptions. And then lastly, something we just talked about, peak cheap oil and gas. Energy is the master commodity. Fossil fuels are still the vast majority of energy expended in around the world. And if it is getting more expensive to find oil and gas, then yes, we can have a green response as that gets more expensive. But when your master commodity gets more expensive, everything else gets more expensive alongside it. Inputs, food, etc. And so that, I think, you can also feed into a real change in the inflationary environment. And then finally, from RD, do they actually increase bond buying to suppress yields if they start to move? In my opinion, the bond market has been managed for some time in a pretty important way. I think that's ultimately the goal of a lot of what we see with QE and central bank balance sheet expansion. I don't think they want to go to explicit yield curve control, because once you're there, I don't think that's the Hotel California that once you check into, you cannot check out of. But ultimately, they're trying to ride two horses with one ass, which is they need to inflate the debt away, which requires significantly negative real interest rates. But they also need to convince the bond market to basically lie still while they kill it, death by 1,000 cuts of negative real interest rates. And ultimately, if the faster they go with negative real rates, the more the bond market will try to sell itself to central banks and really test them. So far they've done a pretty good job, but these horses are riding in increasingly disparate directions. And there comes a day, probably sooner than most think, where they're going to have to show their hands. The Fed, other central banks are going to have to show their hands. Are they going to inflate it away, or are they not? And ultimately, really the only politically palatable, economically palatable choice, given entitlements, defense spending, the fact that U.S. government's 30% of GDP, you put the U.S. government into austerity if you won't print the money. If you're the Fed, U.S. GDP goes into a recession. A recession with 130% debt to GDP means the U.S. defaults on treasuries. It's sort of, you're in deep trouble there. So I think what we're seeing with inflation increases the pressure on these central banks and the Fed in particular, that brings forward that day of reckoning of, okay, which horse are you going to ride? Are you going to inflate it away, or are you going to let the system crash? And really the only politically and economically palatable choice is to inflate it away to supply whatever liquidity is needed. So with that for tonight, I'm going to wrap it up. I want to thank everybody, for their patience. I apologize for the technical difficulties, and we were not able to go live stream with this, but hopefully it was still helpful. And then, as always, thank you for being here. And if you would like to find out more information about what we're up to, check us out at fftt-llc.com. You can find out more about our Tree Rings product, 10 most interesting things, brief synopsis, lays out a lot of the themes and how they either refute or confirm some of the things that we've been talking about that we think are important for people to be focused on as it relates to the macro and thematic. So thanks again for being here tonight, everybody, and we will talk with you soon. Take care.